Good morning, everyone, or I should say good afternoon, depending on what time you're watching this. For those who don't know me, my name is Ashley Hoy. I'm one of the financial advisors here at Bickling Financial Services. And I'm so excited to welcome you guys today to the final part of a three-part webinar series that we've been hosting on estate planning. Today, we are presenting a topic that is a bit more advanced than the last two topics. We're going to be discussing some gifting and charitable giving strategies. And guiding us through that today is going to be Eileen Bregger from OAR Law. Eileen specializes in estate planning, special needs planning, and she is very knowledgeable and I do say very easy to work with as well. So Eileen will be guiding us through this presentation for the next half hour. As you heard in the beginning, the webinar is being recorded for future replay availability. And please save all questions and answers towards the end. There is a chat feature in the bottom. If you do have any questions, feel free to type it into the chat, but we will address your questions at the end. And with that, Eileen, I'll let you take it from here.
Thank you so much, Ashley. I'm really excited to be talking about the topic of gifting and charitable giving strategies today. The presentation will be about 30 minutes with question and answer at the end of the session. Feel free to ask questions along the way. I want this presentation to be as interactive as possible. So many of you on this call probably already have your core estate plan documents in place. Typically, this would include a will and revocable trust, durable power of attorney, healthcare proxy, HIPAA release, and living will. Generally, attorneys recommend that you review your estate plan documents every 3 to 5 years or whenever there's a change in your life or the life of your beneficiaries. So if you have these documents in place, you may be wondering, what's the next step? What can I do to further my estate plan? And if you haven't done so already, you want to make sure that your estate plan is funded. If you have revocable trusts, they should be funded. Because for many of you, for married couples in Massachusetts, there is a type of planning where each spouse has a revocable trust with estate tax planning provisions. And in order for this type of planning to work, the trusts need to be funded. Either assets need to be in trust when you pass away, so it could be through beneficiary designation, or they need to be transferred to trust before your passing. So with this type of credit shelter planning, the whole idea is that a married couple is trying to minimize potential estate tax liability in the survivor's estate. The first spouse to pass away creates what's called a credit shelter trust that holds the estate tax exemption amount for the benefit of the surviving spouse. And what this effectively does is it enables each spouse to utilize their estate tax exemption. And that way you're doubling up. So each spouse doesn't just get, as a married couple, you're not just getting one exemption to use, you're getting each exemption times 2. So you're doubling your exemptions. So it's just really important to make sure that your revocable trust is funded. Oftentimes I work with clients where the engagement is just funding the revocable trust. So their documents are in order, they're perfect, but they don't have anything linked to their revocable trust. And so I work with them, look at their assets, and we determine, what's going to go into trust, what might pass directly to the spouse. It's they say that funding is an art form. So I just want to plant this seed in everyone's head. If you have an estate plan, that's great, but make sure that it will work, that it's optimized, and that it's funded. And if you're not sure, contact your estate planning attorney. So what we're going to focus on today is gifting, freezing your taxable estate. And when I say taxable estate, I mean your estate for estate tax purposes. The idea of gifting is to reduce your taxable estate. There is an estate tax on the transfer of assets when you pass away or if you make a lifetime gift. Okay, so gifting involves an irrevocable transfer. You are usually giving away your assets and you are not going to be a beneficiary of those assets. In order for the tax plan to work, a gift has to be an irrevocable transfer. The basic concept behind gifting is to freeze the value of your taxable estate, because if you make a gift today, all the future appreciation, all the growth and earning on that asset, whether it's real estate or a brokerage account, all of that future appreciation, along with the value of the asset today, is removed from your taxable estate. And this is a very powerful planning concept, because you can give away, let's say you give away 15 million today. By the time you pass away, that 15 million has grown to 20 million. That additional 5 million in growth will escape estate tax. It will be outside of your taxable estate. So effectively, if you're using your exemption, to shelter the 15 million, and then that amount grows to 20 million, effectively you have protected 20 million from estate tax when you pass away. When you're gifting, you want to be thoughtful about how you make the gift to your beneficiaries. And there are different ways to make a gift. You can gift outright to a person, or you can make a gift in trust. And you might use a trust for a number of different reasons. You may want to provide asset protection to your beneficiaries. You may be incorporating multi-generational planning. You're providing for grandchildren, great-grandchildren, and you want to take advantage of your generation skipping transfer exemption. All of that can be done through a trust. Another reason that people use a trust is to really keep assets in the family bloodline. That is another reason. So we're going to be speaking a lot about estate taxes, and so we should talk about the federal estate tax and the exemption. So every U.S. person has a federal estate tax exemption. Currently in 2026 is 15 million per individual, is indexed for inflation. And so that what the exemption means is that you can pass 15 million free of gift and or estate tax. And by making lifetime gifts, you do reduce the exemption that's available to use for estate tax purposes at your death. And that's because the gift tax and the estate tax, federally speaking, are a unified system. So when you make a gift and you use some of that transfer tax exemption, there will be less that's available for your estate when you pass away. Married couples can pass 30 million free of estate tax right now with portability. Portability is not automatic. It has to be elected. The executor of the first spouse's estate has to make an election, file an estate tax return, and make an election to select portability. And that means that any unused exemption of the first spouse will pass to the surviving spouse, and they can use that exemption for gifting or for estate tax at their passing. Now, the federal estate tax is quite high if you are over the exemption amount. It is 40% okay, for the amounts in excess of 15 million for individual or 30 million for a married couple. So it is a very severe tax. And so a lot of the planning techniques that have been developed to minimize estate tax have the federal estate tax in mind, because the rate is so high if you are in that realm. But there also is a Massachusetts estate tax. Here in the Commonwealth, we have a $2 million exemption as of 2023. It did go up 3 years ago from 1 million to 2 million. The tax rate is not as high as the federal estate tax. It's a sliding scale. It's between 8 and 16% on taxable estates over 2 million. Mm-hmm. There is no portability with the Massachusetts exemption. So unlike the federal exemption where surviving executor of the first spouse to pass their estate can elect portability and transfer unused exemption to the surviving spouse, that is not available in Massachusetts. And so effectively, a married couple, like an individual, only has a $2 million exemption unless they do the planning. And that's the planning we were talking about earlier with the revocable trust. By having revocable trust that set up credit shelter trusts when the first spouse passes away, both spouses can use their Massachusetts estate tax exemption. So that effectively doubles the $2 million state exemption to $4 million for a married couple. Another thing to keep in mind is that there is no Massachusetts gift tax like the federal one. So gifting does reduce your Massachusetts taxable estate. It does not eat into the $2 million exemption. However, do note that if you do gift away your assets and you're below $2 million when you pass away, those taxable lifetime gifts will be added back in to determine a filing threshold for the estate tax return. There may be no tax due, but there would be an estate tax that has to be filed. So gifting involves a lot of analysis between estate tax and income tax implications. As I said, a lot of these gifting techniques were developed with the federal estate tax in mind, which has a very high tax rate, 40% over the exemption amount. And so when you're looking at the income tax side, you're talking about capital gains tax and the trade-off between estate tax savings and potentially increasing capital gains tax. And that's because of this concept of basis. If you're gifting away an asset during your lifetime, the gift recipient takes your basis in the asset, whatever your purchase price was plus adjustment. So it's a carryover basis. And later on, if the recipient of the gift sells the property, there could be capital gains tax that they have to pay. Now contrast that with passing an asset at death. If an asset is inherited from somebody, most assets, not retirement accounts, but real estate, brokerage accounts, there is a basis step up. So the basis in those assets will be stepped up to fair market value on day of death. And that potentially can eliminate all of the built-in capital gains that the individual had prior to their date of death. So if the beneficiaries sell the asset, they're right after they've inherited it and there's a step up in basis, there may be no capital gains tax. Okay. So when you're gifting, you are forfeiting that step up in basis. Now, from a federal estate tax point of view, it's a stronger argument because to make a gift, because the federal estate tax, like I said, is 40%. the highest capital gains rate, 20%. So 40% greater, 20%. Whereas in Massachusetts, the highest gift estate tax rate is 16%. Okay, and the highest capital gains tax rate is 20%. So whenever you're doing gifting, working with your team of advisors, you really want to crunch the numbers. You want to know what the basis of your assets are, and you just want to do some projections about the size of your estate, how long of a runway you have to live, and what the basis is, what the capital gain would be. And so it really requires a team. Your estate planning attorney, along with someone like Ashley, your financial advisor, or sometimes your CPA as well, where we run the numbers. So the case usually is more clear for a federally taxable estate. For a Massachusetts taxable estate and deciding whether to gift, you really want to sit down and look at the numbers and make an informed decision. Because if you're gifting, you may be saving estate taxes, but then on the flip side, increasing the capital gains tax that your beneficiaries may pay later. And it all comes down to the numbers. So gifting starts with everyday options. So the first thing when I work with a client, I want to make sure they're taking advantage of their annual exclusion gifts. So the annual exclusion gift is $19,000 this year to anybody. So this is a great way to move assets out of your taxable estate incrementally. So you could give $19,000 to each of your children, each of your children's spouses if you like them, each of your grandchildren. Maybe gift to a 529 account for them. And so this is a great way. Once you add that up, you can start gifting over time, and you can choose each year whether or not you make the annual exclusion gift. If you don't feel comfortable making the gift that year, you don't have to do it. So it's a great way. I always have clients start at this level because, for example, if you're 70 years old, you may have a 25 year runway, $19,000 per year to maybe 2 kids, 4 grandchildren. That can really, chip away at your estate over time. If you're a married couple, you can double that to $38,000 per year to each individual. Mm-hmm. Medical and tuition exclusions. So an individual can pay for someone else's medical bills and tuition without using any of their gift tax exemption. The key is that the payments have to be directly made to the educational institution or the healthcare provider. All right. And educational expenses typically is primarily tuition. It does not include books, room and board, daycare, or summer camp. So this is a great way to reduce your estate. I have a client who has 4 grandchildren. He does not want to pay Massachusetts estate tax. He's planning on paying for all of their college educations directly to the university, though. You cannot pay it to your grandchild's parent and then have them pay it to the college. That will use up your lifetime gifting exemption. Instead, you want to pay it directly to the educational provider. 529 savings plans for college and other educational expenses are a great way to really leverage annual exclusion gifts. So you can super fund a 529 plan by giving 5 years worth of annual exclusion gifts all at once. So for individual, that's $95,000, married couple, $190,000. If you have multiple grandchildren, that quickly multiplies. So the beauty of this is you do not use your federal lifetime exemption for gifting. You save that to use when you pass. And instead, you're just using these tax-free gifts, tax-excluded gifts that do not eat into your exemption. And it's just a great way. Now, keep in mind that if you do front load 5 years of 529 contributions, that you do have to file a gift tax return in the year you make that 5-year gift, to let the IRS know that you're spreading it out. So why use a trust for gifting? There are many different reasons: creditor protection, divorce protection, keeping assets in the family, and multi-generational planning. So a lot of clients want to protect their beneficiaries, your children and grandchildren. They may have a child who has a high liability risk, a child who's a doctor, a therapist, a lawyer. They are afraid that their child could be sued. It could be a car accident. They want to protect the assets from that. Divorce protection. Okay, a trust can be used to protect inherited assets from the reach of a potential divorcing spouse of your child or grandchild. Asset protection is a spectrum. The greatest level of protection comes from using an independent trustee and setting up a discretionary trust. That means that distributions to your children and grandchildren are in the purview of an independent trustee, someone who's not a beneficiary of the trust, probably not related to the beneficiaries. And that is what offers the greatest amount of protection, because you have someone who is not controlled by the beneficiaries, whose discretion to make distributions is completely neutral and independent. And that makes the trust and trust hard to attach in a divorce proceeding. Okay. Now, there are definitely, if you don't have an independent trustee, you can definitely set it up in different ways where your child's the beneficiary or child's sibling. The child is the trustee or the child's sibling is the trustee. That does offer some level of asset protection, just not as much as using an independent trustee, which is the gold standard. Keeping assets in the family. This is about bloodline assets. I have working with a client right now. He inherited a lot of real estate interests from his parents. These LLCs that manage 3 apartment complexes. He is ensuring that his assets pass to his children. So he set aside assets for the spouse, and he's using a trust to make sure the assets pass down to his sons and eventually down to the grandchildren. Okay, so a trust is a great way to ensure that assets stay in the bloodline, because the trust document says they cannot be given to a spouse. They can be protected in a divorce, and they will, when your child passes away, it will pass to the next generation in your bloodline. Multi-generational plan. Again, this is great for very high net worth clients, federally taxable estates, who really want to shield assets from estate tax as well as generation skipping tax, GST tax, which is another tax, 40% on the amount over the exemption, that is incurred when assets transfer to a skip person, a person that is 2 generations below you, like a grandchild. So a lot of the planning is about maximizing and leveraging a person's GST exemption and maintaining that exemption across multiple generations. And this will allow you to create, a greater legacy, because your assets are going to pass not only to your children, but grandchildren and maybe great-grandchildren. So traditionally, gifting involves setting up an irrevocable trust for the benefit of your descendants. So this would include your children and grandchildren. I was told that maybe 40, 50 years ago, the trend was to use one pot for all family branches. So if you had 3 kids, all of them would be beneficiaries along with their own children. As you probably know, that gets messy because families have different needs. They desire privacy. So the trend now is to use separate shares for each family branch. And that's what I recommend. Keep everyone separate. families do not, I don't want to know what my brother is receiving from his trust and vice versa. So I always recommend separate trusts for each family bridge. And again, with these type of trusts where you're where grandchildren and great grandchildren may be beneficiaries, you're implementing multi-generational planning. Irrevocable life insurance trust, what we call an ILIT. Many of you may be familiar with this. You may have your own ILIT. So ILITs are specifically to whole life insurance policies. There's a misconception that life insurance proceeds are not subject to estate tax. That is not true. They are free of income tax. So if someone receives a death benefit, a payout from a life insurance policy, the beneficiary does not pay income tax on it. But the death benefit, let's say it's $2 million, is part of your taxable estate, and it's subject to estate tax. So there's planning that can be done to remove the death benefit from your taxable estate by creating a ILIT trust for the benefit of your spouse and descendants. And that means the proceeds from the policy when you pass away are not only excludable from your estate, but also your spouse's estate, and will pass to your children, descendants, free of estate tax. Life insurance, is often used as for liquidity. So if a family has a really large family farm or family business that's, their wealth is concentrated in one asset, liquidity is going to be an issue one day because the estate tax has to be paid. So life insurance, working with your financial advisor like Ashley, she may recommend life insurance if you fit that profile. You don't want the life insurance proceeds to be part of your taxable estate, so you're going to use an ILIT. And the key is the ILIT has to be the owner of the life insurance policy as well as the beneficiary. So that may require transferring ownership of the policy to the ILIT trust and then naming the trust as the beneficiary of the policy. Okay. If you already own a life insurance policy and you're transferring it to an ILIT, you do have to survive for 3 years in order for the death proceeds to be removed from your estate. So this is not deathbed planning. It really is advanced planning that you're doing now to organize and save on estate taxes. So just a little bit about how life insurance premiums work. When you as the donor and the insured on the policy want to pay the premium each year, you don't want to use your lifetime federal gift tax exclusion. Instead, you want to make sure that your payment of the life insurance policy, which is a gift to the ILIT, qualifies for the annual exclusion. In order for it to qualify, the gift you make to the trust has to be a present interest for the beneficiaries, meaning they must have the right to withdraw the gift. They have to be able to benefit from the gift immediately. And that's how crummy notices were created. So you may have heard of this. The trustee of the ILIT sends a letter to the beneficiaries knowing they have the right to withdraw the contribution to the trust for a period of time. And by creating this withdrawal right for the beneficiaries, your gifts to the ILIT can qualify for the $19,000 annual gift tax exclusion for a beneficiary. Okay.
Eileen, thank you so much for pointing that out, because I think a lot of times when it comes to crummy notices, it can seem like a big process for some people, but it's really a quite simple process of just having this letter pre-drafted that you can sign and send in with that premium, as you mentioned.
Yes, it really falls on the shoulders of the trustee.
Exactly.
That is, but yeah, a lot of times estate planning attorneys will provide just sample letters that the trustee could use every year. Some attorneys will administer crummy these type of trusts and send out the crummy notices each year for a fee. I've heard like $1,000 a year to handle all the crummy notices, something like that. It just depends how much the trustee wants to do on their own versus outsourcing it to someone else.
Exactly. And I know we're already a half hour in, so I appreciate the extra feedback here. Thank you.
Do you want me to run through the rest of the slides very quickly?
That's okay. However long you think, we have another 15 minutes, and
All right.
it looks like we just have 2 questions so far. So
Okay. I will
you're
take
good.
5 minutes to wrap this up. So, can you have your cake and eat it too? All right. Traditional gifting strategies mean that you lose control over what's been gifted because you're not a beneficiary of the trust. So, the Spousal Lifetime Access Trust, a SLAT, was created. This is a trust specifically created for your spouse and your children. And you, as the donor, you're the one giving the assets to the trust, can get indirect access to the trust funds through your spouse. Again, this is a gifting technique. Whatever you give away now, that current value plus any future growth is removed from your taxable estate. Now, there is a risk here if you get divorced or your spouse passes away because you do lose that indirect access to the trust funds. Very important with SLAT planning is that you do not use joint assets to fund the SLAT. You use separate property. So many attorneys who are conservative will make sure, the separate property has always been separate property. There are some practitioners who will, have spouses essentially separate joint assets and then make sure there's a cooling off period before assets are contributed to the SLAT trust. There are different schools of thought about that. All right, annual gifting from your IRA. This is a great way to minimize income taxes and also give to your favorite charity. So this is available to those who are 70 and a half or older. You can transfer $110,000 directly from your IRA to a charity. And this will count towards your required minimum distribution, your RMD. The tax benefit is that the RMD is excluded from your income entirely. And it's not a tax deduction. It's actually better than a tax deduction because it's excluded from your income. It does not affect your AGI. So if you have a higher AGI, that can increase your Social Security, taxes that you pay. So this is great because it's a total exclusion from income. The rule is the money cannot touch your hands. So you have to direct the custodian of the IRA to either write a check or make an electronic fund transfer directly to the charity. Eligible charities include public charities, just kind of art museums, libraries, food banks. A qualified charitable distribution cannot be used to fund a donor-advised fund or a private foundation. Speaking of donor-advised funds, this is a great way to set aside money for charitable causes. You can contribute to a DAF today, get a tax break, an income tax deduction for the money you put in it. And then you can decide and designate which charities get the money in the future. And this is also great to integrate with your estate plan. You can name the DAF as a beneficiary of an account, a life insurance policy, or a retirement account. Retirement accounts generally are great for charitable giving because if they're taxable retirement accounts, like a traditional IRA, every distribution that comes out will be subject to income tax unless you leave it to a charity. A charity will not pay tax on the distribution from an IRA. So they get the benefit of the asset of the account dollar for dollar. So IRAs are a great candidate for doing some charitable giving. A DAF is also great for creating a family legacy. So you can name your children to be successor advisors on your DAF, and they can make charitable grants after your passing. And this is a great way to build, charitable, a charitable legacy for your family and encourage philanthropy in the next generation. Charitable remainder trust. So this is a very advanced planning vehicle. This is a type of trust where the interest in the trust is split between you or a third party and a charity. Okay, so it's a charitable remainder trust. The charity is the remainder beneficiary, and there's an income interest. So the trust can pay an income stream to you or someone you designate for a term of years or for your life, if the actuarial numbers work out. There are very set IRS rules about life expectancy. But this is great if you want to have an income stream for your retirement. So this could pay an annuity to you essentially. And then at your passing or at the end of the term, what's left in the trust will pass to your designated charities. So there are tax benefits. There's an immediate partial income tax deduction when you set up this type of trust. There's also capital gains deferral. So you can take a highly appreciated asset like real estate or stock and contribute it to a charitable remainder trust. The trust will sell that asset and pay no immediate capital gains tax. And so the trustee will typically reinvest the sale proceeds, and they can grow. And eventually the capital gains will come out of the trust, through the income stream. But it's deferred. So you're not paying it immediately upon the sale when the trust sells the asset, but it will be spread out over time. And that's another strategy for tax deferral. Two types of charitable remainder trust. There's a charitable remainder annuity trust known as a CRAT that pays a fixed dollar amount to you or the designated income beneficiary for a term of years or for the person's lifetime. A CRAT specifically is a one and done transactions. You cannot contribute more assets to the trust. So this is usually you're contributing one large asset to the trust and you're not going to make further contributions to it. On the other hand, a charitable remainder unit trust, a CRUT, you can contribute assets over time continuously to the trust. But a CRUT is different. There is no fixed dollar amount. Instead, the trust will pay a percentage to the income beneficiary. And the trust assets will be revalued each year. And the payment could go up and down depending on the value of the trust assets. So it's a little bit more variable. Again, when you're doing planning, the goal is to integrate your charitable trust into your overall estate plan to minimize estate taxes. So that's something you would want to speak to your estate attorney about along with your financial advisor. All right, so we can open the floor to questions now.
Yes, perfect. Thank you so much. So the first question that we have is, I have an irrevocable trust already created and I have some stocks and mutual funds in it. How can I access these funds while I'm alive?
Well, it all depends how the trust was set up. So if you are the one who contributed assets to the trust, you are not going to be a beneficiary, nor will you be trustee. The tax planning would not work otherwise. You wouldn't be removing the asset and the appreciation from your taxable estate. So it really all depends what the trust says. So it may be a slat where your spouse is the beneficiary. So we talked about you have indirect access to the trust funds through your spouse. But typically, if you're the one setting up the irrevocable trust and contributing the assets, you are not a beneficiary. So you do not have access to what's in the irrevocable trust. Instead, the trustee manages and administers those trust assets for the benefit of the beneficiaries, probably your children, descendants. So there isn't really a way where you can gain access to it. Now, some trusts are set up where there's a right of substitution. So you as donor have a right to substitute assets of equal value. And a lot of times this is done because low basis assets in the trust will be exchanged for high basis assets. So that's a tax planning move. The idea is by, taking the low basis assets out of the trust, when you pass away, there will be a step up in basis. But yeah, usually the donor of an irrevocable trust is not the beneficiary. It would no longer have access to the assets after they've been transferred.
Well, thank you. The next question we have may actually be one for both of us, but I'll let you respond. It says you have, I'm sorry, I'm just trying to read this. It says that you mentioned qualified charitable distributions can be made from an IRA starting at age 70 and a half. But my advisor told me that my required minimum distributions don't start until age 73. Are they wrong?
No. So if you're taking a QCD before your RMD age, it just does not apply towards an RMD, but you still get the tax benefit, the tax deduction, and you're also still benefit the charity. But then when you do reach RMD age, then the distribution you not only get all those benefits for making the qualified charitable distribution, it also will qualify for your RMD. So it is available. The QCD is available before you reach your RMD age. So 70 and a half used to be the old RMD age, and they did change that. So now, yes, you can you could take a distribution before you have to, and it would be tax free, but it just would not count towards your RMD because you wouldn't have one. And then later on, when you do reach RMD age, it will count towards your RMD.
Exactly right. As Eileen mentioned, both the RMD and QCD age used to be in alignment at age 70 and a half. But when the Secure Act 2.0 changed required minimum distribution ages, your RMD age may vary from anywhere from the old 70 and a half up to age 75. So if you do not have an advisor, or if you presently do have an advisor, make sure you connect with them to ensure that you are paying attention to when your required minimum distributions will begin and see if the QCDs make sense for you at that time. Eileen, if someone would like to make a consultation or book an appointment with you to have documents reviewed, what is the best way they can reach out to you?
So you could call my office or email. My process typically starts with a 20 to 30-minute meet and greet. I do not review any documents for that particular meeting. The purpose of that initial meeting, or usually it's a phone call or it's done virtually, is just for me to get to know you and understand your situation and what your planning goals are, get a lay of the land. So that, I still do, after all these years, I still do complimentary, initial calls for 20 or 30 minutes. So I'm happy to speak to anyone just to see if I can help them.
Excellent, thank you. And if anyone on this call has a question about whether or not these strategies are appropriate for your assets, please be sure to reach out to your Bickling advisor. If you do not have an advisor here at Bickling Financial, please feel free to contact myself, Ashley Hoy. You can call our office at 781-862-9792 to set up an appointment. And Eileen, thank you so much for joining us today. We really appreciate it.
Thank you, Ashley, and thank you to Bickling Financial for having me speak today.
Of course. Have a great day, everyone. Thank you.
Bye.